The 105-page order issued by SEBI alleging index manipulation by Jane Street, a high-frequency trader, in my opinion, is one of the most thorough investigative reports I have read, and I have been 3 decades in the market. Now, the credit for that report goes to the man who led the investigation, Ananth Narayan, former SEBI Whole-Time Member. Ananth has other achievements in SEBI in terms of trying to curb benami holdings of shares via offshore accounts, as well as SEBI's thinking on AIFs, on stock exchanges, clearing corporations, and above all, investor awareness. My guest today is Ananth Narayan, former whole-time member of SEBI, and of course, before that, a very seasoned forex trader and thinker. Thank you very much, Ananth, for joining us and for being kind enough to come to our studio.
Thank you for having me, Lata.
Well, let me start. Actually, I thought of inviting you because of that Business Standard article that you wrote, where you point out that it is very good that, Indian savers have become investors, come to the stock market, but there are some downsides to this development.
Sure.
Can you tell us what may be the downsides?
So you're absolutely right, Lata. The fact is that the Indian investor is now, really coming towards the capital markets. In fact, as of March 2020, at the time of COVID, we had about 4.2 crore unique investors. That number, SEBI says, has now gone up to 14 crore unique investors. And this is a great trend of actually getting risk savings, patient money coming in and aiding the part of capital formation. Now, that's also translating, by the way, into actual flows coming into the capital market from domestic savers. By the way, while these numbers have grown to 14 crore, the surveys conducted by SEBI show that this trend could actually continue and could reach as high as 25 crores or so over the next few years, as the chairperson of SEBI keeps saying. Now, in terms of flows in FY25, what we saw was across mutual funds, across pension funds, insurance companies, and individuals coming in directly into the capital markets, Indians poured in something like 8.8 lakh crores, which is
FY25 alone.
In FY24-25 alone, which is an equivalent of $100 billion across primary and secondary markets. This, by the way, it was a record and more than twice the previous record. And that trend continues now. So despite about 1.3 lakh crores of FPI outflows during FY24-25, we still had 7.5 lakh crores of net demand for equity across primary and secondary, which, by the way, was an all-time high record, again, 60% higher than the previous high. On the supply side, across IPOs, FPOs, rights issues, QIPs, and offer for sales, we had, again, a record supply of 4.6 lakh crore. Now, for the ecosystem, a record demand for paper and a record supply of paper is the ingredient for capital formation. So it's all great news, right? At the same time, there are a few things to ponder over as we look at this particular trend. Now, there are some structural issues and there are some issues with relation to the investor themselves. So the structural issue, one thing to notice is this gap between the demand for paper and the supply of paper. This has been growing significantly over the last 5 years. So from close to being well matched, it went to 2.4 lakh crores as of FY24 and then rose to a record 2.9 lakh crores in FY25. Now, clearly when you have now, how is this gap being met? It's being met by strategic investors, by owners, by promoters, including foreign owners and promoters, selling in the secondary market, right, and diluting their stake. Now, these are the ingredients of a seller's market. When you have such a large demand context and supply coming in at a price, now that also raises questions about valuation. SEBI would never raise questions about valuation, but it does.
When there is so much of money coming in, share prices are becoming a little unreasonable.
You could argue that
from an FPI point of view.
Correct. From ceteris paribus, everything else being equal, this context seems to favor higher valuations, at least in pockets.
Yes.
Now, we are seeing a result of that as far as net FDI and net FPI is concerned. By the way, not only in public markets has this demand grown up dramatically, even if you look at the unlisted space, including through the alternate investment funds of SEBI, regulated by SEBI, in the last 1 year, closing at September 2025, we saw 2.7 lakh crores of additional commitments being made by, probably HNIs, etc., to buy unlisted paper. Most of the AIFs invest in unlisted paper. 66% or so goes into unlisted paper. So across public markets and unlisted markets, the domestic demand has gone up quite dramatically.
Okay.
Now,
let me come to your solution. I mean, I'm rushing you because I want to get to the other meaty question. Your solution is, one of the solutions could be that we must remove this $7 billion cap of mutual funds investing overseas.
Yeah.
That may be a little difficult at a time when rupees are under pressure, but why do you say that?
Look at the structural implications of this mismatch, right? For one, you could argue that it makes more sense for strategic investors, including foreign investors, to exit right now at good valuations. And we're even seeing MNC names get out at valuations which are much higher than what they get in their own home country, right? Similarly, for fresh investments to come in, for FDIs, they might like the name, they might like the story, but they might find the valuations a little too pricey given the demand context.
Yes.
In terms of the investor side, if you look at the assets under management in mutual funds, the equity portion or the risk portion has grown by more than 5 times over the last 6 years.
Oh.
The non-equity side has grown not even by 2 times. So there is a mismatch in terms of the asset allocation across different asset classes. So from both these perspectives, there are 2 solutions that I think one should debate. One is, we as Indian investors, we need more asset classes beyond just equities. We need commodities, we need fixed income, we need hybrids, we need InvITs, REITs, munis, all of that entire bevy, and they should be available at scale in a tax-friendly manner as a choice for asset allocation. Yes. Given there is so much of risk savings coming, we need better asset allocation for better investment outcomes. From a external perspective, you might think that restricting money from going outside is actually good for a balance of payments. I would argue that could be actually a perverse outcome here, where by restricting money from going outside, you're actually making it difficult for capital flows to come in. And as many people have pointed out, including yourself, right now the problem seems to be net capital inflows. So in a funny way, it's just as you have in the case of the trade account.
Yeah.
When you try and put trade controls, import controls, you think you're doing a favor for the trade deficit. Actually, you end up making your trade exports non-competitive and therefore lower, right? In a funny way, this could be playing out in the capital sense as well. By restricting folks from going outside, you're making your markets inefficient. You're giving wrong price signals to companies who don't have to take very high risk and do investments to get the right valuations. And on top of it, you're actually restricting capital inflow. So now, to your point, I think, yes, we've got to allow for more asset classes. We also have to, in a graded manner, nobody's suggesting do a big bang thing tomorrow. In a graded manner, allow Indians to invest overseas and diversify their portfolio. I think the mutual fund route makes the most sense for the simple reason that when you and I invest through a mutual fund, our units remain in the country in rupees. When we eventually redeem, the money has to come back to India. If we go through an LRS, that money is probably lost forever. It will go out of the country and it will go out forever. Similarly, for an average Indian, the LRS route is not user-friendly. There is a TCS involved, there is an opening an account in an overseas jurisdiction who might not pay attention to you because you're too small. Given all of these, I think increasing the mutual fund limit, allowing our good fund managers to do the asset allocation on our behalf and move some money outside, maybe $1 billion every month over the next 12 months or so, might be a good way to let off some steam. At worst, it will mean a part of RBI's reserves come into household balance sheets as external assets in the form of equities or some other mix. Yes. At best, I think it could net result in capital flows coming back into the country as the markets become a lot more efficient and is perceived to be a lot more efficient.
Fair point. I mean, I hope this argument washes with all the regulators. Clearly, the mutual funds will be happy. But, I mean, my viewers will want to ask you this question. After your Jane Street investigation, did you see any difference in the way high-frequency traders behave? Did you see a reduction in, market-leading behavior?
So, Lata, 2 quick points on your preamble as well. One is whatever speaking orders come out from SEBI, they're a SEBI work. They're not a work of a particular individual. Second, I really don't want to comment about any specific enforcement action. SEBI never does that. I have certainly not done that. And the matter is sub judice anyway. So I really don't want to speak about that particular case.
Okay. Let me come to another issue in which you may be at least involved as a member. The restrictions on derivatives. I mean, clearly it was for all to see, the weekly expiries. Do you think more controls are needed?
The first thing I would like to reiterate, and I think the chairman of SEBI has done this on multiple occasions as well, nothing will happen without adequate data being put out, without adequate debate happening, and without adequate consultation happening. So rest assured, every time we see markets going through some palpitations of rumors of something coming up today, tomorrow, that ain't happening. So just to, get the perspective right, the first set of consultation papers were put out in July of last year, 2024. The first circular came out in October 2024 after significant consultation and after many changes from the original draft. Similarly, the second consultation paper came out in February of this year, and the circular came out in May of this year after significant consultation and tweaks. Now, to again recap what the issue was, and we've said this at multiple occasions, there were three issues that we were grappling with as SEBI. First is, of course, the extraordinary amount of losses that small investors seem to be facing, particularly on index options on expiry day, 93%, and that to over 1 lakh crores of total net losses and so on and so forth. That is a clear area of concern. And the concern and the debate has always been, should you have some suitability appropriateness filters to actually ensure that only those who are aware come into these markets, right? The second part, which we've pointed out again, is a structural issue. Now, we've noticed that on expiry day, the cash equivalent amount of volumes that get traded in index options is sometimes 700, 800 times the volumes being traded in the underlying cash market of the constituents. Now, this is almost like the LIBOR issue, Lata, where your benchmark is being set in relatively illiquid markets compared to the derivative markets. And therefore, the chances of the cash tail wagging the derivative tail is very, very high. And that obviously raises questions about the need for greater supervision, surveillance, and maybe some regulatory measures as well. So that's an issue that we are grappling, or we have been grappling with. The third issue is that, literature tells us that a healthy derivative ecosystem is one where a majority of the contracts are beyond 1 month. Long-term investors or even speculators do the best when they have a lot of long-term contracts available. In India, we've noticed that most of the contracts mature over the next 1 week, let alone beyond 1 month. So getting the term structure of derivatives right is again something that we've tried to grapple. Now, against all of this, two things that we will keep in mind, and I'm sure when I say we, I mean SEBI. Now, I can't speak for SEBI anymore, but nevertheless, I'm sure SEBI will keep this in mind. One is we've taken a significant number of steps, whether it is the October circular, the May circular, and so on and so forth. So what is the impact of all that on volumes is something that SEBI, I'm sure, will look at, and they will put it out in the public domain, and that can then answer your question about whether more steps need to be taken for these three objectives, right? The second thing that we can't lose sight of, many market intermediaries and market infrastructure institutions, depend upon derivatives for revenues. Now, that's a real politic. That's something you cannot ignore, and if you do something dramatic in terms of trying to, reduce the volumes in the market dramatically, with the best of intent, you could have unintended consequences in the entire marketplace because you're simply upsetting the apple cart of the entire ecosystem. So whatever has to be done in a very thoughtful manner. I have no doubt that SEBI will continue to be extremely thoughtful in whatever it does. It will be consultative. Nothing will be taken in a precipitate manner. The larger issue which Chairman Tuhin Pandey has also been working on ever since he's joined, I think is the issue of investor awareness and education.
You know what? I'm completely running out of time on my first segment. I have to take a break. But the all-important question of high increase in margin-funded trading has suddenly become a question. That question after the break. Stay with us. Welcome back to this very special Indianomics. My guest, I've been speaking with Ananth Narayan, former whole-time member of SEBI, and in his previous avatar, a very experienced forex banker as well. Ananth, thank you very much for your patience. Well, before going to the break, I told you that one of the things that people are talking about now is the rise in margin-funded trading. It was about 7,000 crores in June, July, and now it is 1.15 lakh crore in November. Is this over-leveraged market and trading a worry?
So there are multiple angles here, Lata. So you're right, the pace might be dramatic, but the reality also is that the numbers that you mentioned are still small in relation to the total market capitalization of our equities right now, which is what, 460 lakh crores or so. Similarly, it is small in relation to the overall banking credit book. Forget about banking plus NBFC. Banking alone is close to 200 lakh crores. So it's not as if these numbers by themselves are too worrisome. But one, of course, the pace is something that needs to be tracked. Second, besides margin MTF, you also have to look at what is the total loans against shares. That is something that has to be looked at as well. And finally, what I think all regulators have been worried about or have been trying to figure out is there unsecured loans taken by retails making its way into capital markets, particularly to derivative markets. Now, I can tell you this from my experience at SEBI and therefore the dealings with the other regulators. This is something that the regulators and the Financial Stability Council are well aware of and are well seized of. And I'm sure they're working on keeping a track as to what really is happening. At this point of time, I would suggest there is nothing much to worry about. And I think regulators are seized of this. And I'm sure they're tracking this very, very closely.
Okay. Yeah, actually, Reserve Bank also keeps a close eye on unsecured loans. And at the moment, actually, the worry has declined. It was much worse in 2023. Okay, let me come to, the corporate bond market. You have worked as a banker on that market and then as a regulator. What do we do in terms of promoting the corporate bond market?
I think the first committee that I ever joined in markets 30 years ago was on how to deepen the corporate bond markets. Okay. And I had a lot more of hair on my head that time. Now, look, I think we've come a long way. And I think the number of corporate bond issuances and outstandings have gone up dramatically over time. And it's also true that in general, corporate bond secondary markets tend to be smaller than equity markets globally. It's not a new phenomenon. But I think there are a few things we can do. For one, I think the trading culture that permeates the equity ecosystem can be copy-pasted into the debt ecosystem as well. I would love to see people like you actually talking about trading calls in corporate bonds and different types of credit. And I think if we build the infrastructure in the ecosystem, make the tax treatment both for trading as well as for holding corporate bonds equivalent or at least comparable to that of the equity ecosystem. If we make the trading and settlement ecosystem, including guaranteed settlements, including what you do in case you can't deliver a particular security, what is the fallback mechanism, if that can be equalized to what happens in the equity ecosystem, there are a bunch of Indians who love to trade, right? If we can trade complicated things like index options with all of its Greeks, there is no reason why we can't trade corporate bonds. So I would, it sounds strange coming from an ex-regulator, but I would love to see a trading culture develop in corporate bonds. And to our earlier discussion, Lata, I would love to see avenues for retail investors in a tax-friendly manner at scale to be able to invest in fixed income as well, particularly as they become more open to taking on risk.
Yeah.
Right?
Actually, on this issue, I have more faith in the private sector. If companies like Zerodha and Grow will get into this, they will find a way. I only hope tax authorities oblige. That, to my mind at least, is a roadblock. But let me come to, one of the things that you were very passionate about whenever I spoke to you and met you at SEBI, investor education. I mean, there is, as you pointed out in your first reply, that, there is a quadrupling of number of investors in just last 4-5 years. So what should SEBI do about this?
So you're right. It's a key area for SEBI, and it's always been a key area. And particularly with the new chairman, it's again a huge area of focus. Look, the role on financial inclusion is very different for RBI from SEBI.
Yeah.
For RBI, it's about opening a bank account, get everybody to open a bank account. For SEBI, it is please don't enter the capital markets unless and until you're aware of the risks that surround capital markets, right? So mutual funds sahi hai, but mutual funds are subject to market risk. Please understand both parts before you actually enter the capital markets. So few things that, I would love investors to be aware of, and I'm sure many of them are already aware of. For instance, there is this very seminal paper by Barber and Odeon in 2001, slightly tongue-in-cheek, which says boys will be boys, gender, overconfidence, and trading in equities. Okay, it goes to show that women make more money than men in trading or actually in investing. Okay, and the reason it gives, don't beat me up for saying this, I'm just quoting the paper. The reason it gives is that men are confident, they think they know, so therefore they trade more, therefore they lose more, and therefore they make less. Women are more diffident, and therefore they trade less, and therefore they lose less, and therefore they make more. Long story short,
the lesson is, if you trade less, you will make more money.
as a small individual, the odds are stacked against you. You have to pay STT, you have to pay exchange fees, you have to pay brokerage fees, you have to pay SEBI fees. There are transaction costs, and therefore every time you trade, the chances of you losing are higher. Trade less is a mantra which not many intermediaries will talk about, but that's the real investing lesson that has been borne out by ample research, including domestic research by SEBI as well. The second thing is this, again, seminal paper by Brinson, Hood and Biebauer, I think 1986 or so, which showed that all this discussion that we do about stock selection and timing of the markets, that accounts for 5 or 6% at best of the difference of returns in different portfolios. About 94% of the returns, or the difference in returns across different portfolios, is explained purely by asset allocation. So once you choose your asset allocation across equities, fixed income, commodities, foreign currency, real estate, and so on and so forth, your return is pretty much decided. So the long story short, if you're doing financial planning and making your wealth work for you, A, you should figure out what your risk appetite is. Then you should construct a diversified portfolio and asset allocation across all these assets, such that the overall risk of this portfolio mirrors what your risk appetite is, and that's a unique risk appetite. By the way, Harry Markowitz, the father of modern portfolio theory, actually said this, that the closest thing to a free lunch is diversification. So you should be diversifying across these assets. Your only trading in the markets would be either to fresh invest or to rebalance periodically every 1 or 2 or 3 years. So that's the limited approach. Now, after knowing all this, if you want to experience the thrill of markets by trading and getting in and getting out, that's absolutely fine. It's a mature country.
But know that that is not...
Absolutely right. So we all like, I'm sorry to use this very silly kind of a parallel, we all like maybe perhaps going to the casino once in a while. We know the casino, the house will always win, but we go there for the thrills. So you be aware of the risks, be aware of what the odds are, be aware of what the right strategy ought to be for the average person. Thereafter, how you spend your hard-earned money is your call, if you're not in any state, right? So, but this is the essence of investor education, I think. In fact, we need speculation, we need derivatives, we need trading, but we want informed participation in capital markets. For the average investor, knowing the risk, asset allocation, diversification, and rebalancing should be the mantra.
Okay, and that's a superb lesson and a superb point at which to end this conversation. Ananth Narayan, thank you very much for joining us. And now that you're not burdened by being the regulator, we hope we will get the benefit of your advice off now.
Thank you so much for having me.
That's it on this edition of Indianomics. Thanks for watching.